Look, anyone can find a shiny rock and print a colorful map, but very few have the stomach to drag a project through a decade of permitting hell, navigate the brutal gauntlet of capital formation, and actually flip the switch on a mill. We are sitting here in February 2026, and the game has fundamentally changed. The era of drill hole roulette is taking a back seat to a new class of titans, the Elite 11. These aren't speculative maybe projects anymore. They are de-risked factories that are transitioning from consuming cash to printing it. We're talking about a collective $17 billion in net present value that the market is currently pricing at nearly a 1-to-1 ratio. That is an absurd mathematical disconnect. Today, we're breaking down the roadmap from now until 2029, showing you exactly where the geological stories end and the cash flow machines begin. If you want to see where the next mid-tier legends are being forged in real time, grab your coffee and turn it up. Welcome to Junior Mining Gold, the podcast where we dig deep into the raw, unfiltered world of building fortunes from the ground up. I'm your host, Dusty Nugget, the guy who's ridden more boom and bust cycles than a rodeo cowboy on a bull named Recession. If you're new here, we don't sugarcoat the grind. We expose the guts of business, from solo hustles to empire-building shares. Before we dig into the dirt, this episode is brought to you by juniormining.gold. Are you tired of missing the boat on the next big discovery? juniormining.gold is your ultimate radar for the high-stakes world of small-cap mining. We track the drills, the assays, and the movers so you don't have to. If you want an edge, head over to juniormining.gold. Now, let's get to the gold. Today's episode is all about the moment the real money gets made in this game. We're calling it the Elite 11 Emerging Producers 2026-2029, the class of juniors that are no longer just stories in the ground. They're crossing the line into production, turning geological lottery tickets into industrial cash flow machines. We're sitting here in February 2026, and Madsen just fired up commercial pours 6 weeks ago. The watch list is now a production schedule. This is the inflection point where explosive value creation happens, not at discovery, but when the mill starts humming and cash starts compounding. Let me hand you a mental model right up front, because this is where most folks get it wrong. Mining isn't about finding shiny rocks. It's about de-risking them into factories that print money. These 11 companies, spanning gold, copper, uranium, lithium, rare earths, have permits in hand or damn close, feasibility studies locked, infrastructure pathways secured, and timelines to first pour from this year through 2029. They're the backbone of the old economy and the electrified future. Each follows the same brutal arc: stranded asset, technical validation, capital formation, production ramp, and finally, cash flow compounding. Now, zoom out to the aggregate punch. Taken together, these Elite 11 pack $17 billion in total after-tax NPV across their flagship projects. That's not hype. It's feasibility-defined, discounted cash flows at conservative prices. Layer on $12 billion in combined projected free cash flow over the first 5 years of steady-state production. And the kicker, their collective market cap sits around $19 billion right now. Do the math. The street is valuing these companies at roughly 1x, or slightly above, the NPV of what's already in the ground, paying mostly for proven de-risked assets, with little premium baked in for the next discoveries, expansions, or the compounding magic once cash starts rolling in. That's extraordinary asymmetry. In the emerging producer phase, the market treats you like a geological story. But once you hit production, stabilize output, and start spitting free cash, valuations flip. You become an industrial engine, trading on multiples of cash flow, not just net asset value. Margins widen with rising metals prices, debt gets paid down, dividends or buybacks enter the picture, and the re-rating can be ferocious. This is where juniors become mid-tiers, and mid-tiers become legends. The window's open now, in February 2026, before the herd piles in. To give you the boots-on-the-ground view, I've pulled 4 standouts, one from each time frame, that have cleared the hurdles and are executing. Let's start with a company in the 2026 class. Right out of the gate, on January 1st, just 6 weeks ago, West Red Lake Gold flipped the switch to commercial production at the Madsen mine in Ontario's Red Lake district. This ain't greenfield roulette. They inherited a fully built underground mine with over $330 million of historical capital already sunk by the old-timers. They refurbished the mill, de-risked the resource with aggressive drilling recently, and bam! They're pouring gold and generating cash right now. The most recent study, the January 2025 pre-feasibility study, lays it out crystal clear. Base case at $2,000 gold. Post-tax net present value with a 5% discount rate is $231 million. Post-tax internal rate of return of 170%, and payback in just 1.5 years from first pour. Average all-in sustaining cost sits at a lean $1,681 per ounce, with average annual free cash flow around $51 million once they're at steady state. At current gold prices, that NPV jumps north of $360 million in the sensitivities. That's the kind of leverage that turns a restart into a rocket ship. According to the PFS mine plan, the first 3 years of production look like this. 2025 is the ramp-up year, with 35,000 ounces expected. 2026 grows to 63,000 ounces, and 2027 approaches 67,000 ounces. They're already beating the early ramp in real life. The mill hit 689 tons per day in December. Commercial production declared January 1st, and management is guiding towards 50,000 ounces for this full ramp-up year, with high-grade zones feeding the mill. Full permitted 800 tons per day, steady state by mid-2026, and every extra ounce drops straight to the bottom line because the heavy lifting on infrastructure was done decades ago. Permitting was a breeze as a past producer. Funding, strategic raises backed by heavy hitters like Frank Giustra gave them the war chest for final optimizations. Bottom line, West Red Lake isn't a mining company anymore. They're a cash flow machine. Every ounce now converts hard into operating cash, and with that PFS blueprint locked in, the upside from high-grade panels and potential expansions is pure value unlock. This is the mining equivalent of buying a fully built, high-grade factory for cents on the dollar, while gold is screaming higher. Here's a sample from the 2027 class. Osisko Development's Caribou Gold Project is the definitive play in Western Canada. Located in the historic Wells-Barkerville camp of British Columbia, a district that has seen gold mining for over 160 years, Caribou is a fully permitted brownfield revival that has been de-risked to the teeth. The project hit a massive milestone in late 2024 when it received its final environmental and mining permits, making it the first project ever to clear the rigorous new British Columbia environmental assessment process. As of February 2026, the company has officially moved into the execution phase, awarding a major construction management contract to JDS Energy and Mining to lead the build-out, with early works already advancing and a massive infill drilling program confirming bonanza grades, including recent intercepts as high as 596 grams per ton. Caribou is on a direct path to its first gold pour in the second half of 2027. The economics from the optimized 2025 feasibility study are built for the current gold environment. At a gold price of $2,400 per ounce, the project delivers a post-tax net present value of $698 million, a post-tax annual return of 22.1%, and rapid payback from first production in just 2.8 years. At spot prices north of $3,300 per ounce, those numbers explode. The net present value jumps to over $1.53 billion, with the annual return climbing to 38%, and the payback period shrinking to a mere 1.6 years. While the project carries an initial construction cost of $652 million, Osisko Development has been aggressive in securing the necessary capital. They completed a massive $143 million financing in February 2026 to push through final engineering and long lead orders, significantly reducing any near-term funding risk. The production profile establishes Caribou as a foundational Canadian asset. Once the underground operation reaches its full capacity of 4,900 tons per day, it is expected to produce an average of 202,000 ounces of gold annually during the first 5 years, with a life of mine average of 190,000 ounces per year over an initial 10-year span. Operating efficiency is a core part of the story. By using modern ore sorting technology to separate waste rock before it even reaches the mill, The company keeps its all-in sustaining costs at a lean $157 per ounce. This technology not only fattens the margins, but also reduces the project's environmental footprint, a key factor in maintaining the strong support they've secured from their local First Nations. With all major permits in hand, construction underway, and a world-class team at the helm, Caribou isn't just a development project anymore. It is a mid-tier producer in waiting, ready to become a primary cash flow engine for the back half of the decade. By 2028, the global nuclear renaissance isn't just a talking point, it's a full-blown supply crisis, and NexGen's Arrow mine in Saskatchewan is the apex predator of the uranium space. Located in the southwestern Athabasca Basin, Arrow is arguably the most significant high-grade uranium discovery in history. This isn't just another mine, it is the cornerstone of Western clean energy security. They are currently moving through the final regulatory red zone. Federal hearings with the Canadian Nuclear Safety Commission wrapped up on February 12, 2026. With provincial approval already in hand, and all 4 local Indigenous nations publicly backing the project, the final federal license is the last major domino. Once that falls, the transition from developer to builder is instantaneous. The economics, updated in the most recent 2025 financial analysis to reflect the current high-price environment, are staggering. Using a uranium price of $95 per pound, the project delivers a post-tax net present value of $4.5 billion, a post-tax annual return of 45.2%, and payback on initial investment in only 12 months. While initial construction capital is estimated at $1.58 billion, NexGen has been a masterclass in capital management. They closed a massive equity raise in late 2025, pushing their cash balance to approximately $860 million. This gives them a massive head start on ordering long lead equipment and performing site work without the need for immediate further dilution. The production profile is a beast for a reason. According to the feasibility study, Arrow is designed to produce an average of 29 million pounds of uranium annually over the first 5 years. Peak production hits nearly 30 million pounds, roughly 25% of the entire global supply from a single site. NexGen has already begun locking in this value through strategic offtake agreements with major American utilities. As of early 2026, they have committed more than 10 million pounds of uranium over the first 5 years of production. Unlike older contracts in the industry that are capped at low prices, NexGen's deals use market-related pricing. This means they get to capture the full upside of surging spot prices at the time of delivery, while providing utilities with the supply certainty they are desperate for. This demand is being fueled by a new generation of nuclear technology hitting the grid right in NexGen's backyard. In Ontario, construction is already well underway on the first of 4 small modular reactors at the Darlington nuclear site. This project, the first grid-scale deployment of its kind in North America, recently hit major excavation milestones in early 2026 and is on track to begin powering hundreds of thousands of homes by the end of the decade. These smaller flexible reactors represent a massive new buyer class that needs the exact high-grade, reliable supply NexGen is built to provide. Operating costs are where NexGen separates itself from the pack. Because Arrow is a land-based, basement-hosted deposit, unlike the technically difficult, water-saturated mines in the Eastern Basin, it uses conventional mining methods. This keeps the total cost of production at an industry-bottom $5.69 per pound for the first 5 years. With these offtake agreements already in place and the Department of Energy pushing for domestic supply chains, NexGen isn't just building a mine, it's building a monopoly on low-cost, high-grade production. By the time they pour first yellowcake in 2028, Arrow will be the engine that powers the next generation of the grid. Now let's turn to our last example project of the Elite 11. By the end of the decade, the electrification of the global economy will live or die by the copper supply, and Arizona Sonoran's Cactus project is perfectly positioned as a domestic anchor. Located on private land just 45 miles south of Phoenix, this brownfield restart is a rarity in the mining world. A massive, low-risk project in a Tier 1 jurisdiction that can move from final study to production in a fraction of the time it takes a greenfield site. Permitting is moving at a sprint because the project sits on private ground rather than federal land, bypassing the years of regulatory deadlock that stall most American mines. They recently cleared a major milestone with the receipt of their industrial dust permit in January 2026, and the remaining state-led environmental permits are expected by mid-year. With the finish line in sight, management is targeting a final investment decision by the end of 2026. The project's most recent financial study, released in late 2025, showcases the kind of leverage copper investors crave. At a copper price of $4.25 per pound, the Cactus project delivers a post-tax net present value of $2.3 billion, a post-tax annual return of 22.8%, and a total life-of-mine free cash flow exceeding $7.1 billion. What makes this project a value unlock is the existing infrastructure. Because it is a past-producing mine site with direct road, rail, and power access, the initial construction capital is a manageable $977 million. This is world-class capital intensity for a project that will become one of the top 3 copper cathode producers in the United States. The production profile is built for the long haul. Once first cathode production begins in the second half of 2029, the mine is expected to produce an average of 226 million pounds of copper annually over the first 10 years. A total mine life of 22 years, with billions of pounds of copper still in the ground for potential expansion. Operating costs are aggressively low due to the use of conventional heap leaching and solvent extraction technology. The total cost to produce a pound of copper is expected to sit at $2.01, providing a massive margin of safety even if metal prices fluctuate. Arizona Sonoran enters 2026 with a fully funded work plan and a cash balance of approximately $105 million. This war chest allows them to lock in long lead equipment and finish their final feasibility study by the second half of this year. As the U.S. government pushes to secure domestic critical mineral supply chains, Cactus isn't just a mine, it's a strategic industrial asset ready to fuel the energy transition. So there you have it, 4 builders, key commodities, elite teams that figured out the grind, bureaucracy, capital, execution. The full Elite 11? See the link in the show notes to go deep on the rest. The Elite 11 are turning holes into cash machines, right now. Remember, mining involves risk. So do your own research. You're still here? You listened this long? Well, a bonus for you. Here's another one of the producers in the Elite 11. It's Perpetua Resources at Stibnite in Idaho. This is gold plus antimony, that critical mineral the Department of Defense is desperate for in munitions, semiconductors, and advanced defense systems. They cleared the monster hurdle, the final record of decision from the United States Forest Service in January 2025, after nearly a decade in permitting hell. Final federal permits followed in May 2025, financial assurance was posted in October 2025, and early works construction kicked off that same month. Detailed engineering is already nearly 50% complete, power contracts are signed, and they are marching toward a full construction decision in spring 2026. The Department of Defense has thrown more than $80 million in awards behind this project across multiple programs, a massive strategic tailwind that says this asset is simply too important to fail. Here is where it gets juicy. The most recent financial update released in February 2025, built on the detailed feasibility study with updated costs from basic engineering, delivers world-class numbers at current spot metal prices, an after-tax net present value at a 5% discount rate of $3.6 billion, an after-tax internal rate of return of 27%, and payback in just 2.2 years. Even at more conservative long-term consensus prices, the project still throws off a $1.3 billion after-tax net present value and a solid 15.4% internal rate of return. All-in sustaining costs net of byproduct credits are industry-leading. Only $435 per ounce of gold in the first 4 years, rising to $756 per ounce over the 15-year mine life. Initial capital, including contingency, sits at $2.5 billion. This is a brownfield revival on a historic site that will also clean up legacy contamination, restore fish passage, and reconnect river habitat, turning an old environmental liability into a net positive. In the first 3 years once commercial production ramps in 2029, The project is expected to deliver approximately 463,000 ounces of gold per year. That is the high-grade early production phase, where the real cash engine fires up, backed by substantial antimony byproduct credits that make the margins even fatter. Low costs, dual commodity leverage, national security mandate, and a shovel-ready restart in America's backyard. This one is not just a mine, it is a strategic asset the country actually needs. Too important to stall, pure value unlock in the making. This is Dusty Nugget. Sometimes mining isn't about striking it rich overnight. It's about seeing the long game, taking the smart risks, and engineering your way to the win. Stay bold, stay scrappy, and I'll see you at the next drill site. You can learn more at juniormining.gold. Please like, subscribe, and visit our socials or our Substack for more content.